Have you ever wondered about the different categories of Indian citizens living abroad and how it affects their rights, duties and taxes? Well, let's dive into it together. So imagine you're an Indian citizen living abroad or planning to move to another country. Knowing your residential status is key, right? It influences the taxability of your income and your investment opportunities in India. But it's not always easy to figure out. Now let's talk about non-resident Indians or NRIs. NRIs have made a significant impact on India's financial condition through substantial remittances into the country. Think about the India Development Bonds of 1991 and the Resurgent India Bonds of 1998. Great examples of the Indian diaspora's contributions. But here's the thing. Determining whether you're an NRI or not can be a bit tricky. So let me ask you, how can you figure out if you're an NRI? Well, here's the answer. To determine your NRI status, you need to consider factors like the number of days that you have spent in India during a financial year and your intentions to stay abroad. But let's switch gears a bit. Ever wonder about the PIO and OCI categories? PIO stands for Person of Indian Origin and OCI stands for Overseas Citizen of India. They are similar, but there are some differences when it comes to their rights and privileges. So in the grand scheme of things, understanding your category, NRI, PIO or OCI, is vital for making informed decisions about your finances, investments and ties with India. Let's do a deep dive into the nitty-gritties of non-resident Indians first, and then we'll elaborate on PIOs and OCIs thereafter. So who is a non-resident Indian? Who is a non-resident Indian as per FEMA? Who is a non-resident Indian as per the Income Tax Act? The basic differences between FEMA and the Income Tax Act in the classification. Adding a twist, resident but not ordinarily resident. How to calculate the number of days. The treatment of NRI under the Aadhaar Act. First, let's address a fundamental question. Who is an NRI? In everyday conversation, you're considered an NRI if you're an Indian citizen living abroad for a substantial period of time. But when it comes to the nitty-gritty of legalities, things get a little bit more complex. So here's my question to you. Do you know which laws determine your NRI status in India? Well, the two main laws that come into play here are the Foreign Exchange Management Act of 1999 or FEMA and the Income Tax of 1961. These laws govern different aspects of your residency status, and this can sometimes lead to a lot of confusion. Now let's get in a bit deeper. Can you guess how FEMA and the Income Tax Act differ in determining your residency status? FEMA primarily deals with your financial transactions and investment options. On the other hand, the Income Tax Act focuses on how your income is taxed in India. Since these laws have different purposes, there are both similarities as well as differences in how they define whether you're a resident or a non-resident. Alright, here's a scenario for you. Let's say you're leaving the country for overseas employment. What happens to your residency status? And what kind of an account will you have according to FEMA? If you're heading abroad for employment, you become an NRI immediately. Your accounts would be converted into NRO accounts as per FEMA. But here's the twist. According to the Income Tax Act, your residency status is determined at the end of the financial year. They calculate it based on the number of days that you've spent in India during that fiscal year. So here's the kicker. You might find yourself in a situation where you're considered a resident for income tax purposes, while you could be a non-resident as per FEMA or vice versa. Now that can be a bit confusing, right? Well, that's why we're here, discussing these details in depth so you can have a crystal clear idea of what it means to be an NRI and the limitations that come with it. To clear the confusion, let's first understand who is a non-resident Indian as per FEMA. When we say the FEMA guidelines, the rules that regulate the residential status of NRIs in India, these are governed by the Government of India through the RBI and implemented by authorized dealers such as banks as well as financial institutions. See, to open and maintain bank accounts and make investments in India, you have to determine your residential status according to FEMA. So let's get to the heart of it. What's FEMA's definition of an NRI? According to FEMA, an NRI is a person resident outside India who is a citizen of India or a person of Indian origin. We'll talk more about PIOs in a bit, but hold on. Before we go any further, let's talk about who FEMA considers as a resident. Do you know how FEMA defines a resident? According to Section 2 of FEMA, a resident is defined as a person residing in India for more than 182 days during the course of the preceding financial year. But there are some exceptions. Now here's where it gets interesting. FEMA looks at your intention to determine your residency status. Let's break it down. If you go abroad for employment, business or professional purposes, you are considered an NRI from the very first day of your departure. The period of your stay in India does not matter in this case. For example, if you leave India on 1st of Feb 2023, you're officially an NRI from 2nd of Feb according to FEMA rules. What about students heading abroad for studies? When do they become non-residents according to FEMA? Well, you're right on track. Students leaving India for studying abroad are considered non-residents from the very first day of their departure from India. Now let's talk about returning to India permanently. What's the deal there? If you're returning to India permanently, you'll be considered a resident from the very first day of your return. Here's another interesting tidbit. FEMA does not explicitly define the financial year, but it's generally assumed to be from 1st of April to 31st of March. And here's the cherry on the top. Once you become an NRI according to FEMA, you become eligible to make investments in India, including in the likes of mutual funds and real estate. So these are the ins and outs of FEMA guidelines and how they determine your residential status. The next step is to understand who is a non-resident Indian as per the Income Tax Act and how it determines how your income is taxed in India based on your residency status. According to Section 2, Part 30 of the Income Tax Act, a non-resident is simply someone who is not a resident. But what exactly makes someone a resident under the Income Tax Act? That's where it gets a bit more detailed. So here's the scoop. An individual is considered a resident in India during any previous year if they are in India for 182 days or more during the year, if they have been in India for 365 days or more during the 4 immediately preceding years, and for 60 days or more during the financial year. Now let's break it down further. What happens if you don't meet these conditions? Well, if you don't meet these conditions, you become a non-resident for tax purposes. But hold on, there are some exceptions and modifications to these conditions. For example, if you're leaving India for employment, business, or perhaps as part of a crew on the Indian merchant ship, that 60-day condition becomes superfluous. And here's an interesting twist. If you're an Indian citizen or a PIO living abroad but visiting India, the 60-day condition is replaced with 182 days. Now here's where it gets more intriguing. The Finance Bill of 2020 added another layer to this. Can you guess what that change was? The 60-day condition was changed to 120 days if your income in India is more than 50 lakhs during the previous year. But there's a catch. This change applies if you're not a tax resident in any other country. Let's put this into perspective with an example. Let's say Mr. Vikram visited India from 10th of April 2022 to 15th October 2022 and earned 16 lakh rupees as income during this period. Now, how many days was he in India for? Only 167 days. But thanks to the 2020 amendment, he's still considered a resident for the year 2022-23. So here's the bottom line. Starting from assessment year 21-22, if you're an Indian citizen earning a total income in the excess of 15 lakh rupees other than from foreign sources, and you're not liable to pay tax in any other country, you will be deemed to be a resident in India. That's a lot to take in, I know, but understanding these rules can have a significant impact on your tax liabilities. Okay, let's continue on our exploration of the differences between FEMA and the Income Tax Act. Since FEMA is a regulatory law and income tax is a revenue law, there are bound to be some variations. Let's take a look at these differences. Now let's shift gears a bit. Do you know how FEMA and the Income Tax Act handle the time frame for determining your residential status? Well, FEMA looks at the preceding financial year, while the Income Tax Act considers the current fiscal year. So there's a bit of a time lag between the two. And here's where it gets interesting. How do these two laws consider the purpose of your stay? FEMA takes into account the purpose of your stay in addition to the number of days. Meanwhile, the Income Tax Act focuses solely on the number of days. Now let's talk about the practicality of it. How is your residential status determined concerning financial transactions in both these acts? Under FEMA, your residential status is assessed at the time of every financial transaction. But under the Income Tax Act, your residential status is finalized and recorded when you submit your income tax return. Here's another interesting aspect. Can you be both a resident and a non-resident in a single year under the Income Tax Act? That's a great point. According to the Income Tax Act, you can be either a resident or a non-resident in a year. But there's a twist. You can also be a resident for a part of the year and a non-resident for the remaining part of the year. So the key distinctions between FEMA and the Income Tax Act when it comes to determining your residential status. Now, these differences can have a significant impact on your financial planning as well as taxation. Moving on to the third category introduced by the Income Tax Act. Resident and not ordinarily resident, or RNOR. Here's a quick question to kick things off. What is RNOR and why is it important? RNOR is the third residency status introduced by the Income Tax Act, and it's a game changer. It's particularly relevant for NRIs returning to India for good who have been residing abroad for a significant period. RNOR status offers some tax relief during their transitional phase. Now let's get into the details. What are the conditions that define an individual as RNOR? There are 4 conditions that can easily classify you as one. You've been an NRI in 9 out of the 10 previous years preceding the year in question. You've been in India for a period of 729 days or less during the 7 previous years in question. There are 4 conditions that can easily classify you as one. You've been an NRI in 9 out of the 10 previous years preceding the year in question. Income from foreign sources. You're an Indian citizen or a PIO with income of 15 lakh rupees or more, excluding income from foreign sources, and your stay in India in the previous year was between 120 days and 181 days. Here's the interesting part. The last 2 conditions were introduced in the Finance Bill of 2020. Do you know why? These conditions were brought in to attract high net worth individuals who plan to stay in India to avoid paying taxes elsewhere. The resident and not ordinarily resident status, a crucial category for those transitioning back to India or high net worth individuals looking for tax advantages. All these concepts look okay to me, but the main question next is how to calculate the number of days. Understanding the tax residency status based on the number of days spent in India. It's crucial to get this right because it can have a significant impact on your tax liabilities. So here's a question for you. How's the number of days you've spent in India during a financial year determined? To calculate the number of days, you need to count all the days that you were physically present in India. Now, this includes the day you arrived in India and the day you departed. And guess what? Immigration date stamps on your passport pages play a crucial role here. In fact, the Income Tax Department needs to verify your stay. They might even request copies of your passport pages to determine those dates accurately. Now, let's talk about an interesting scenario. Suppose you're joining a merchant ship in Indian waters. How is your departure date determined in such cases? Now, in this situation, the stamp on your continuous discharge certificate, or as we call it CDC, when you join the ship will be taken as your date of departure, even if you're still in Indian waters. Now, let's bring this concept to life with a few examples. Here's the first one. Suppose you arrived in India on 1st August 2022 and left on 31st January 2023. How many days would you have spent in India? The number of days in this scenario would be 184. So you would be treated as a resident for the year 2022-23 according to the Income Tax Act. Now let's consider another example. Lokesh leaves India on 15 December 22 for employment and continues to stay abroad. How does his residency status pan out? Since Lokesh's stay in India exceeds 182 days, he will be considered a resident as per the Income Tax Act. However, he'll still be a non-resident as per FEMA. So there you have it, the basic concepts of calculating the number of days to determine your residency status. The next angle to understand is how NRIs are treated under the Aadhaar Act. Alright, we're talking about something quite practical and widely used, the Aadhaar card. It's a valuable identity proof that can simplify many processes like opening a bank account and meeting KYC requirements. So here's the question. Is it mandatory for NRIs to get an Aadhaar card? Well, it's not mandatory for NRIs to obtain an Aadhaar card, but it's highly advisable given its convenience. Is there any eligibility criteria for NRIs to apply for Aadhaar? NRIs, despite being Indian citizens, are eligible for an Aadhaar card only if they have stayed in India for more than 182 days in the last 12 months. Here's something practical. What documents do you need to enroll for an Aadhaar card as an NRI? Well, to enroll for an Aadhaar card, you'll typically need a copy of your passport. And here's an important tip. Please make sure you register your email address because registering overseas phone numbers in case of Aadhaar card is not possible as of now. Now let's consider your family. Can your spouse and children also get Aadhaar cards? Well, your spouse and children can indeed get Aadhaar cards if their names are linked to you in your passport. Last but not the least, do NRIs need to link their PAN card with Aadhaar? Unlike residents in India, NRIs are not required to link their PAN card with the Aadhaar. Before we wrap up, I want to emphasize the importance of seeking professional help when it comes to determining your NRI status and navigating the associated tax regulations. So here's a question for you. Why do you think it is advised to seek professional assistance in these matters? Well, laws can change over time, and they often do, especially in response to shifting political as well as economic landscapes around the world. With an increasing number of NRIs investing or expanding their investments in India, it is absolutely crucial to ensure that your residency status and taxation matters are properly assessed well in advance. Consider this. What aspects of your life could be influenced by these laws, and why is compliance important? These regulations can touch various aspects of your life, including your employment, your investments, property transactions, and much more. Compliance is essential because it ensures that you're on the right side of the law, helping you avoid any unexpected surprises down the road. So here's the bottom line. While there are some differences between FEMA and the Income Tax Act, it is vital to comply with these regulations. Professional guidance can be your best friend in this journey, which can help you make informed decisions and navigate all these complexities of NRI's financial and tax matters. Thank you so much for joining us today. And remember, knowledge is power, especially when it comes to your finances and taxation. Until next time, stay informed and make those smart financial moves.